Man, look, people in real estate are getting their asses handed to them every day.
Would you invest your hard earned money in a socialist country that didn't respect private property rights? If your answer is no, then why would you invest your hard earned money in a city or county here in the United States of America that had a socialist city or county council and didn't respect private property rights? So, look, ownership is becoming an illusion in places like New York City, Baltimore, DC, Seattle, LA, because you've got more and more draconian anti ownership rules that are being put into place. Now, if you watched the last video we did on New York City real estate, you saw how quickly a local government can use nonprofits to erode private property rights. The scary truth in that is that if your asset cannot get up and move, if it's not portable, then it is at the mercy of whoever is in power. Right now, even the biggest, most bulletproof investors, you're talking about Grant Cardone, Donald Trump, others, okay, like them or not, all right, they own a lot of real estate. They're sitting on a multi-billion-dollar trap, pretty much.
Man, look, people in real estate are getting their asses handed to them every day. They got their hands full. They think my little Bitcoin thing is cute, but they can't even get their heads wrapped around their own problems. Because remember, the real estate guys dealing with evictions and property taxes. If you're in New York, you're dealing with Madami. If you're in California, you're dealing with Newsom and all the exodus. If you're in Florida, you're dealing with insurance problems. Bitcoin has none of those problems. No insurance, no gutters, no evictions, no tenants, no termites, no bed bugs, all upside. And the only possibility is it doesn't do anything for long periods of time, which is what it does, by the way. It does nothing for 350 days of the year, and then for the last 10 or 15, it'll go nuclear.
All right, so for decades, we've been told by gurus, economic, real estate gurus, that brick and mortar real estate is the safest foundation for generational wealth. And it has been for, quite some time in this country. Now, Grant Cardone, like him or not, he's built an entire empire telling everyday investors to pool their money, buy massive physical apartment complexes, and wait for the cash to flow. But what happens when the ground beneath those buildings becomes a political playground for people like Zohran Mamdani and Sia Weaver up in New York City? What happens when radical local policies shift from protecting tenants to actively weaponizing nonprofits to snatch private deeds from owners? All right, so let's take a look at this transformation, this transition that investors need to start thinking about from fixed capital to fluid capital. And I'm going to show you why the traditional real estate model is officially exposed to this new paradigm that's sweeping through many of the blue cities in America. That paradigm shift is one that's taken us from equity, building up equity over time, and capitalism to full-on socialism. And what is socialism? Well, it is government seizing the means of production. And Mamdani and his crew up in New York have made it very clear that that's exactly what they want to do, especially where real estate is concerned. All right, so in today's world, as an investor, if you want to be successful, you're going to have to understand a concept called the Immobile Capital Trap. So when a giant fund like Grant Cardone's buys 500 apartment buildings in one complex in a specific metro area, they aren't just buying concrete and steel. They're looking at effectively making a permanent bet on the future political stability of the specific city or county council where that building is located. Their wealth is held hostage by a political and a geographic boundary. So it's a shame, but we've got to start looking at the United States of America and jurisdictions throughout this country in the same way we would examine areas overseas before putting down investment capital. Would you invest in the Congo? Okay, probably not, because of the Marxist bent that most of the sub-Saharan African countries adhere to, and also because of political instability. Now, we're going to continue to talk about this, what just happened in New York when a jurisdiction decides to implement predatory tenant opportunity laws or to allow nonprofits a first right of refusal to effectively hijack a private sale. A landlord cannot just pack up an apartment complex and move it to a friendlier state overnight. So if a radical city council decides to target corporate landlords, guys like Grant Cardone can't liquidate $1 billion in physical property on a Tuesday afternoon. They're sitting ducks, basically. Their capital is completely immobile, deeply and very highly visible, right? Look at what Mamdani did with one of the wealthy people in New York City.
That video and its backlash rattled the city's business community after the infuriated CEO, Ken Griffin, threatened to grow jobs in Florida instead of here in New York. This week, that backlash continued with a lecture from President Donald Trump and, according to sources, efforts by Mayor Mamdani to reach Griffin falling flat.
Well, today, we're taxing the rich.
Almost 1 month after Mayor Zohran Mamdani posted this video singling out Citadel CEO Ken Griffin's pricey penthouse to promote a new pied-à-terre tax.
Like for this penthouse.
The mayor has tried to open a conversation with Griffin, according to several sources in the business community familiar with efforts to reach Griffin through an intermediary. But the sources say Griffin was in no mood to speak to the mayor and may be holding out for a public apology. Soon after the mayor posted that video, Griffin said it had put him in harm's way, was in poor taste, and would cost the city jobs.
We will add far more jobs in Miami over the next decade as an immediate and direct consequence of the mayor's poor decision here.
Okay, so there you have it. You see a very antagonistic approach from the mayor of New York City to one of the individuals that's provided a lot of jobs and opportunity in New York. Really weird, right? But that is what socialists do. So you even heard Griffin say, hey, look, let's create some jobs in Florida where they, treat money better. But that just proves, by Mamdani showing up at the guy's apartment, how highly visible real estate is. And it's incredibly easy for local governments to regulate, penalize, or tax your ownership out of existence. This is happening in New York City, where they have already taken apartments from some owners under the guise of, oh, well, they weren't meeting a whole bunch of bureaucratic benchmarks. And look, I'm not suggesting that all of these landlords are angels. No way. If you are a slumlord, then fine. Okay, you should have to come up to code. And if you don't, then there should be a way to transfer that asset from you. Now, you own it, okay, but you're not doing the right things with it. So transfer that asset from you with market rate compensation to someone else who's going to do a better job with it. I get that, okay? Or you should just be disallowed from being able to rent that property out, all right? Which would hasten your desire to sell that property off because you're not going to be making any money off of it, right? It's just going to be sitting there. So how do you protect your net worth if the traditional Cardone model is exposed to massive political risk? Your transition from vertical wealth to horizontal sovereignty is what you need to start really looking at. So this means deliberately shifting a percentage of your capital into assets that possess fluidity, okay? Assets that can change jurisdictions, operations, or ownership structures at the click of a button. And you heard Cardone talk about Bitcoin as one of the assets that he prefers that has those characteristics. So let's look at 3 alternative ecosystems where smart capital is not just fleeing now, but positioning itself in order to be shielded from predatory socialist politicians that don't respect private property rights. All right, first up, private digital infrastructure. So instead of dealing with local housing courts or eviction moratoriums such as the one we had during the 2020 crisis, there's a new wave of investors who are out there acquiring cash flowing digital real estate. So think niche software as a service companies or automated digital media networks. Now, some examples of this include concepts like instead of buying a physical commercial building, investors are using platforms like acquire.com. Flippa is another one. And they're using those to buy boring, highly profitable micro software as a service companies. So we're talking about things like uh, automated property management plugins, niche Shopify inventory calculators, B2B invoice generation tools. So these software applications are actually charging business owners a monthly recurring subscription fee, acting exactly like digital rent. And what you're doing by investing in this is you're not going up there into California actually mining for the gold yourself, but you are invested in the pans and all of the equipment needed to do that. All right. So you don't face the same risk that you would if you had the giant apartment building in the middle of New York City, right? So when you look at, let's call it the fluidity factor of this, your customer base is actually global. Your overhead is near zero. And if one state passes a predatory tax law, you can actually route your corporate entity to a business friendly jurisdiction instantly. The state can't seize a digital asset hosted on decentralized servers, at least not yet. All right, now let's look at sovereignty commodities. The things, more of the things required to make things work, right? So you drive past the building and you think about all of the rents that are being collected by the property owner, but do you think about underlying infrastructure that is needed to make this whole arrangement work? So we're in the middle right now of a massive global boom in artificial intelligence and tech infrastructure. And what does all of this infrastructure require? Raw power and computational data centers. So, again, looking at our fluidity factor, the capital is moving heavily into private energy infrastructure syndicates. Governments don't penalize data center infrastructure. They actually, like in Frederick County, Maryland, unfortunately, that they protect it. They subsidize it because it's tied directly to national security and global tech dominance. All right, and then there's tokenized real world assets. So if you absolutely love real estate and you want that yield as well as those tax incentives, you no longer have to own the entire localized liability like a traditional syndicator. Fractionalized ownership. I'm a huge fan of fractional ownership. Fractional ownership via blockchain actually allows you to hold pieces of high yield commercial property across multiple international borders simultaneously. Now back to our fluidity factor. If a radical policy or some joker like Mom Donnie comes into play and starts to affect one market, it doesn't touch your holdings in landlord friendly markets like, for example, looking outside the United States, United Arab Emirates, okay, certain countries in Central America or certain parts of Europe. You end up getting real estate upside pretty much without having to be exposed to the hyper localized political environments that we're finding again in certain places right here in the USA. All right, so look, I don't want this just to be a video. I want you to actually put these practices under a microscope and examine whether or not any of this or any configuration of it can be applied to what you're out there doing to build your empire. Okay. So I want you to actively develop the mindset of protecting your money. from governments who are anti-capitalist, right? Many of which are local and state right here in the United States of America. So this week, what can you do? I want you to run a 3-step audit on your current portfolio, calculate your regulation risk score. So what you have to do is first locate friction points. What percentage of your total wealth requires direct permission from a local government body to sell, lease, or liquidate? If it's over 70%, you're overexposed. Now, what do I mean by this? Well, in Washington, D.C., you have to, before you sell your property, okay, you put in the blood, sweat, and tears to buy the property. You made improvements to the property, but before you sell it, if you've got a renter in there, you got to give that renter first right of refusal. It's not enough just to put it on the market, and if the renter can do it, then they do it. No, you got to take time and wait and have them figure it out. So if you have 70% of your net worth tied up in an apartment building in Washington, D.C., that you're not even allowed to sell without government interference, you're overexposed. Next, track your jurisdiction. Are your physical assets located in regions with declining business metrics or aggressive regulatory histories? Right here in Maryland, for example, we got another metric: rising energy costs. Our energy costs have gone up 89.3% in the past 18 months. Okay, so you got to look at all this in terms of your due diligence. Number 3, establish a liquid escape hatch. Do you have, let's say, a baseline of 15 to 20% of your portfolio in hyper-fluid, decentralized, or internationally decoupled assets that can fund your next play if a worst-case legislative scenario hits your home market? Gold is another one, okay? Gold is recognized around the world, right? It's not something that Zorhan Mamdani can come in and try to seize from you, at least if he doesn't know you have it. All right, so the illusion of traditional ownership is fading in certain areas of the United States of America. True ownership in the modern economy, it belongs to those who are agile, quite frankly. Don't let your hard-earned wealth get trapped in a broken market just because a real estate guru told you that physical property is the only way to scale. Now, if you're ready to start building a sovereign high-yield portfolio that no local politician can regulate out of existence, hit subscribe. We're doing things a little differently here on the Soldiers of Finance channel. We are becoming much more actionable in terms of the information we provide, and we want your feedback. No one's coming to help you, okay? Not the government, city, state, federal. They're not coming to help us. We have to figure it out on our own. America is a business. Pay me. And that's what we're doing here is we're looking at ways to make that happen, to become more self-sufficient, and to also, unfortunately, shield ourselves from an economic predatory government in many cases.